thank you everybody for joining our panel today. We hope to make it very interesting and discussion-oriented. So I'm Donna Hutchings, and I'm responsible for AsiaPac for Citco. And we've got a great panel here today, and we hope that it will bring home to a few people in the region. So starting first, we're going to actually get everybody to do a quick introduction of themselves, their family office, and their investment style. So I'm going to start first with Justin.
Sure, absolutely. So my name is Justin. I'm the principal of Kingsfield Holdings. We're a single family office based in Hong Kong. So I worked on the sell side at Goldman, Morgan Stanley, UBS, and also in tech at Uber before I got the call back from my family to start Kingsfield Holdings. We've always had an endowment style approach to our asset allocation. So over half of our investments are actually in alternatives. The two biggest buckets, I would say, are hedge funds and private equity direct deals. And on the public market side, we like to use derivatives and structured products to optimize our returns and also create a more fixed income-like characteristic for our portfolio.
Awesome. My name is Chow. It's very nice to be here. I'm the CIO at Global Tech Capital. Global Tech is a single-family office based in Taiwan, and I'm based in Hong Kong. I'm also an adjunct professor at HKUST in the finance department. Our allocation includes early stage ventures all the way through growth stage, PE buyouts, credits, and public equity. We take a global approach. Majority of our allocation is in developed market. We do have marginal allocations in emerging markets as well.
Hello, I'm Jonathan Fine. I'm with a single family office representing a French family. This is more about capital preservation, so we allocate to across equity, hedge funds, fixed income, commodities, but we also do sustainability related investments directly.
So the company I'm working for is Alps Capital Management. It's a multi-family office based in Hong Kong. We've been rooted in Hong Kong for 30 years, so my mandate is actually quite wide. So we have about 14 family relationships. So that means we have a very wide range of different mandates, from income, return, to diversification. So liquid, illiquid, equity, fixed income, we cover the whole lot.
Okay. Thank you. So I guess we'll start with you, Vincent, a little bit about how do you think the US elections are going to change your investment strategy for APAC and global, if at all, of course?
Sure. I think fundamentally it hasn't changed a lot. I mean, it doesn't change very quickly, doesn't it? What changed is really the valuations. I think what's interesting is, before we went into the election, if you talk to anyone about what's going to happen, everyone was like, oh, it's about 50-50. So, and because of the high uncertainty, it's better to be more conservative, And as it turns out, Trump win quite easily, and I think the first order effect we're already seeing it. So people are focusing on the fundamentals likely to do well. So equity is doing fine, dollar strengthen, and everything, and China, of course, is not doing so well. I mean, for two reasons. One is the policy is underwhelmed, and the second is also because they're concerned about the trade tariffs. So for me now at this juncture is more about the second order effect. So the second order effect is what would likely happen of that relationship from a geopolitical perspective. That's number one. And number two is also about what does that mean for the U.S. economy, because the U.S. economy is already doing really, really well. So is it likely to be very inflationary? And what does that mean to interest rate outlook and everything? So yeah, it does change, because at first, I think most of us are waiting for that, correction maybe, so we can adjust our portfolio better. But now it seems like, things are doing even better. So it does make, the valuation more stretched. That means, I will try to position more carefully, at this juncture.
And how about you, Joe? Any other differences that you may have being from a single family office?
Right. I echo strongly what Vincent had just said. So from a long-term perspective, I would say that there is no impact or very little impact in our investment allocation. We all know that from a long-term economic growth model perspective, there are many factors determines how the long-term economy pans out, but the election result is probably not one of them. So we focus more on the fundamental drivers, even the demographics of countries for the long-term perspective of our asset allocation. But in the short term, our biggest concern is the risk of reflation. That will have some impact on our short-term deployment of capital. We do have to watch out for the risk of reflation in the States and how that's going to impact our portfolio, especially on the credit side and equity side.
So that's a nice lead into the next question. The panel's about patient capital as well, right? And how does that impact your investment style versus a standard fund manager? So Justin, do you have a perspective on how you approach that in your day-to-day investing?
Sure. I mean, we're a single-family office, so by nature we are patient, long-term, evergreen capital. I mean, my job is to preserve, create, and pass on generational wealth. Having said that, we do take into consideration liquidity concerns when it comes to investment decisions. We don't just buy and hold forever. So a good example of us being patient would be, so with Blackstone REIT, we were early investors in that. The fund was almost a victim of its own success. It grew to a size that we weren't too comfortable with, so we wanted to get out. We were one of the LPs that had to wait 2 years to fully redeem because of the gating situation. I think it was 2% per month, 5% per quarter. But listen, I have all the time in the world, so I was happy to wait to get out, because if they fulfilled all the redemptions at once, the NAV would have tanked. So the gating did exactly what it was designed to do, and after 2 years we got out, and I was net up 50% on the trade, so I was happy to do that. Now on the flip side, I do get impatient sometimes, especially when it comes to PE deal exits, especially when it comes to IPO, lockup expiry exits. Whoever sells first wins, so I'm very impatient with that. So with that, we normally work with UBS to, one, receive the shares, and two, they give me access to their IB algorithms to sell. One particular algorithm, it depends on the bid side paddle volume, so I'm able to sell very discreetly and quite quietly in the market on the day of expiry.
And I guess, Vincent, from a multifamily office perspective, do you have a little less patient capital or similar?
I think, well, absolutely. Conceptually, I mean, you can imagine we are a solution provider, strictly speaking. So we don't have the leisure of, staking capital. So if, I mean, obviously, if we're not doing a good job, then obviously, people can put the money anytime. So from that perspective, you can call, we're impatient in some way. However, always trying to stress that, I think what people tend to forget is, we're not asset managers. So there's a reason, there's a distinction between the multifamily office and the asset manager. So I mean, the moment you position yourself as an asset manager, then obviously, it's very performance driven, and then obviously, it's all about, out winning, something, but we're not. So what it means is, you have to understand, what your client needs. So it's more about the solution providing. So you need to understand, each and every individual family issues, and then trying to provide a solution accordingly. And when you do that, then it's all about the education, all about explaining, communicating, on a clear basis. So if you're doing the right job, then you should have some sticky capital. But otherwise, obviously, yeah, you will get measured all the time.
Yeah, and I guess one of the things when we were preparing, you also talked about getting transparency, being able so that you can pass that on. How important is that to you?
Yeah, transparency is paramount. I actually, I always say, so if you invest into something, I mean, if you can guarantee, performance, absolute return performance, yeah. Well, but when you don't, then I need the information, because I have a fiduciary responsibility to for my clients. So when something happens, that's why when I look at the prospective manager, sometimes I try to explain to them, I'm really looking for partnership. So as much as I like to think about investing into something, I mean that actually go back to the question about I rather patient or impatient. So that impatient actually coming from if I can't provide the information my client is looking for, and the investment strategy that I'm looking into, they can't do the same for me, then obviously it's not helping each other. So that will go back to that question. If we're not doing the right job, not providing communication, then clearly the capital will not be patient.
And then, Joe, how about you from your perspective? Closed-end, open-ended, lockups, gates, do these play a critical part in your decision making on when you're investing?
Right. Vincent and I, we discussed this a little bit. So we're from a single family office. The perspective is slightly different. For us, open-end fund, closed-end fund, both have their own characteristics and offers diversification effect to us. So we do allocate to both. For the open-ended fund, we like the potential liquidity option. So far, we haven't taken any early redemption liquidity options, but we like it to be there. Same time, we are aware of the risk of potential downtime bank run situations, which we've seen in other cases. To us, we are so-called patient capital, long-term thinking, so that doesn't really bother us as much. For closed-end fund, it's more classic, traditional, slightly less liquid, and we do need to plan ahead of time on our cash flow. But it does offer some formal structure that requires the managers to plan strategically, and we do like that perspective of closed-end fund.
Yeah. At least you have a more certainty and understand the length of term you're locking up for.
Exactly.
Yeah. And I guess, Jonathan, you have a bit different of a background as, right on the website it's talking about responsible investing, right? So when you add that into the mix of lockups, et cetera, how does that responsible investing play a part in your decision making?
So maybe to first start with the idea of patient capital. So we used to think of ourselves and we used to tell people, hey, we're patient capital. And we also have an impacty approach to things. We've also stopped saying that as well. The issue of telling people that you're patient capital and you're focused on impact is people think that you can accept low IRR. So in the past where we've gone wrong, looking back, we've been too patient and we've been maybe too hopeful that things would turn around and we can just ride it out. But then we're invested in something for 10 years and we get 1.1x. It's not really a happy situation. So right now we're much more sensitive to performance. We're much more sensitive to liquidity, and we've become much more vigilant over time. With regards to impact, we need returns in order to achieve impact.
Yeah. And would you look at two managers and go, okay, I think they're similar, and that becomes the tiebreaker for you when you're investing, and making sure you don't invest in anything that's, I guess, the opposite of the family views?
So for allocations to a plain vanilla real estate private equity fund, it doesn't really come up too much in the conversation. So we have a list of questions that we provide to the manager. But actually, if there's no red flags, we're happy to proceed based on the strategy and the performance. Right now, where we're focusing more of the impact and the responsible investing is on the direct investments, where we invest 10 to 30 million euro per company in businesses that are doing recycling or new materials, mobility, agriculture, and these kinds of things.
So a bit more on the direct investment side.
Yeah.
And Vincent, for a multifamily office, do you have to juggle different people's perspective, or is it really, as Jonathan said,
absolutely,
returns?
Absolutely. I mean, different mandates, different requirements, and I mean, naturally thinking, you would thought, engaging in lock-in kind of product, can lock in the client. It doesn't work like that. It's more about the circumstances. So that's why, if you don't, you come back, to the patient and impatient again, I guess. So if we're not doing the job, we're not understanding the client's circumstances and situation, and then give them, the wrong products, then obviously, people understood, and there will be no client relationship. So the decision is really about, understanding, what they're looking for, and then provide a solution accordingly. So lock in or not lock in, at a high level, obviously, if you think about, if we're given, the same playing opportunities, and then obviously liquidity matters. But otherwise, it's really what driven that decision is about the circumstances of the client.
And Justin, from your perspective, are there any other considerations that you look at when you're evaluating an investment, either direct or indirect through a fund manager?
Sure. I mean, structure for us is very important. Vincent, you mentioned transparency paramount. Structure is paramount for us. I'd rather not do a deal than do a deal where the structure is less than perfect. Especially when it comes to PE direct deals, the stars really have to be aligned. It has to be the right target company, the right valuation, minimal layers, minimal fees, and for us, most importantly, the SPV manager has to be reputable and trustworthy. You're doing these deals for 5+ years, you're in bed with these people, you have to make sure that you trust them. I'd rather buy a block where it's more expensive with a more reputable SPV manager than a cheaper block with a bad actor. And I've definitely come across a few bad actors, meaning there's a lack of communication or they're delivering shares late. So I really have to choose wisely with that. Now, when it comes to hedge funds, kind of like the larger hedge fund players, I actually prefer to go via the feeder funds of private banks, even though there's an extra layer of fees. And the reason why is because the feeder fund, I'm not subject to the fund level gating or the fund level lockup. So a good example would be earlier this year, I redeemed a blue chip, very famous platform hedge fund. I was the first person in this bank in Asia to redeem this fund. And as long as the bank was able to find another client to take my place, I was able to leave very quickly. So again, we do sell and redeem these funds regularly. Just because we're patient doesn't mean I don't want to redeem or take profit.
And then, Joe, do you have anything to add around that?
I really agree what Justin has said, the importance of the structure. Just a few simple rules within our family office I'd like to share. We don't really like SPVs, but there are times that we have to join SPVs. So we do spend a lot of time trying to verify the organizer of the SPV, making sure it's a trusted party. Generally speaking, we'd like to be on the cap table ourselves, but given the deal size and our ticket size, it's not always possible. We would definitely not invest in via double layer SPVs. There is so much risk, and we had bad experience before with those type of layers and structures. On the public side, we do sometimes form SMAs for strategic purpose for very specific type of strategies.
And getting a little closer to home, Jonathan, what's your perspective on investing with APAC managers?
So we don't have that much allocation to APAC managers. The APAC managers that we do have are across the entire region. So it's like an APAC real estate fund or an APAC private credit fund. The challenge with managers in this region is that they're often pitching the story of their country. Why should you invest in India? Why should you invest in Vietnam? Or why should you invest in Indonesia? Whereas they don't have that much differentiated strategy with how they're going to especially make money within Vietnam or Indonesia. And then you're just riding the index and you're taking a bet that the manager has some special local knowledge. But the problem is if India now, for example, becomes very overvalued and you've invested in an Indian fund, you're stuck. And that manager is going to continue to invest in that market, even if there's better opportunities in another market.
Yeah. And are there managers in Asia are not always as big as global or have the longevity as some of the global managers that you can invest in?
Absolutely.
Does that also play a factor?
Correct. Relative to the larger fund managers like KKR or Actis or Schroders or whoever, a lot of the fund managers in Asia are relatively new. So they have only done the strategy for 3 years or so, and it's hard to judge what happens with that strategy in different circumstances. They don't have the risk control, and they may also not have the investor relations function. If we've got questions, who's going to answer our questions? When you're investing with a larger platform, it's just it's an ease of doing business and a comfort issue.
Many of you are talking about trust, so that's a key component, and the longevity gives you some of that. So, Vincent, do you have a different perspective on APAC, or?
I mean, well, I can resonate that. I mean, to be honest, I mean, if you think about the regional managers, I mean, it's a reflection of the underlying, isn't it? So if the underlying is not as developed and sophisticated, so then the strategy, they usually, they have a cycle, they come and go quite often. I mean, take China market, for example. I mean, unfortunately, as much as you like, I mean, yes, it may be a second biggest economy. However, the asset market is not as well developed as the US, unfortunately. So that means, it is more of a, exposed to the boom and bust cycle that we've been seeing. So that manager longevity is also, hand on to that, So when they do well, they go back. When they don't, they shut. So that's what happened. So I think, that's really, when you think about the APAC investment universe, it's really thinking about, the underlying universe. Exactly, to Jonathan's point of view, if you like, India or not, Vietnam or not, So that's an issue. And that's also a reflection on, because the size matter, the longevity is a matter. So then obviously the typical, governance, that you're looking for, may not be in place. So I think that's ultimately is the problem.
Yep. And then, right now private credit is being mentioned all over the globe, right? It's and it is growing in APAC as well, right? So how do you feel, Justin, about investing in private credit? And
I mean, we've allocated private credit. I think, how could you not? Every financial advisor under the sun has been pounding the table on private credit for the past year. So we allocated to larger, more seasoned managers. That's how we did it. I'll say this, I'm a little bit worried about the velocity of capital going into private credit right now. We're starting to see private credit managers gate both the subscriptions and redemptions, which I think is a good thing, because they just can't deploy the capital fast enough. We're seeing deals overbid, we're seeing paperwork getting loose. And Donna, you mentioned most of your new clients at Citco have been private credit. Some of these new managers, they haven't gone through a down cycle, so I'm a little worried what things might happen when things go south.
yeah. And then from an Asian perspective, I mean, there's so many countries for origination. Do you focus on any particular countries, or?
Funnily not, no, we focus on US.
Okay. And I guess I also had Jonathan, how about you from a private credit perspective?
So I think a lot of the overinvestment in private credit has come in the US, in my perspective, where there's so much there. Whereas in Asia Pacific, there's still not that much. And I think that the story of why private credit should overperform in Asia still makes sense. So for example, if you're a run-of-the-mill private equity fund and you're trying to leverage a portfolio company 3 to 4x, still outside of some banks in Singapore and Taiwan and Hong Kong, you're not going to be able to find that credit, and you could very well have an opportunity to provide a mezz or a slightly higher interest rate debt to a private equity fund and get quite a nice return. I think that there's much more opportunity in the market here for private credit as compared to the US.
Okay. And from a return perspective, a risk-adjusted return, do you feel that APAC will give you the extra as compared to the US?
Yeah, so I would say so. So for private credit in Asia Pacific, we're looking at low teens net IRR. And in the US, maybe some people can talk about that, but I will be more doubtful of whether or not they will be able to return that 5 years from now.
Yep. And we only have about 30 seconds left, so I'll open it up to the panel to see if you have any other points that you want to make for our guests here today.
I think one of the things that I pick up, from the panel today is, I think it seems to us, we all fairly, US-centric, developed market-centric. But that's also, not only because, this is a reflection of, how developed the market has been, but also how strong the economy and the market has been. So I mean, if you think about, some of the questions that we thought about, so if the ultimate happened, the US dollar de-dollarization, the deficit of a sudden become a problem, then ultimately, I think, if you ask the same question, a couple of years down the line, I think you'll get very different answers.
Great. Well, thank you everybody for participating in our panel and for the guests joining and coming. I hope you've enjoyed it. And great, thank you.
Thank you.